Yeah. Sound good to me. This sound hard. Some funky people gon' dance to. Give the record a second and a chance to. Hitting people like a scene of amazement. While they slipping back, my feet just planted in the pavement. Crumble I can never do. So now I'm looking dead at you. What are you gonna do? You listen to the knowledge of a scholar. You say how I breathe, tell them how I holler. I'm the E double, and I proclaim my name straight up. Good gang, peeps all game. I'm like a rhino running through the roughest pack. They figure I'm a trigger happy nigga, so they step back. Breathe. The microphone is who lasts the longest and who's the strongest. It ain't a game, it's plain to see. You listen to the sounds of breathe. There ain't no future in your front. I never got caught with a kilo, and if you ever do, yo, and never be with me, yo. Serve it in the Cherokee, or maybe it's a Geo. Black on black Benzo, we'll get it up amigo. Never have to.
Hey, it's Soleil, and this is episode 429 of the Orange Pill Investor. And the title is just a little nod to the beatings will continue until morale improves. So I was going to go live a couple of hours ago, but then I had forgotten or saw that Adrian had his True North Now, and it was interviewing Semler. And so I tuned into that and did some grocery shopping. So that was fun. But sneaking in an episode before the market closes, good news in the market. And I mean, Bitcoin is not up today, but maybe it's just a little bit of a reverse hangover from it being up over the weekend. And there's got to be a few people out there sniffing out the fact that S&P 500 inclusion qualification is all but assured, because they only need like about 96,000 Bitcoin at the close of Q2. So this is basically a wrap at this point. No guarantee that the committee will just roll over and be like, okay, cool, you erased 4 quarters of EPS, we're going to let you in on the first shot. And so if they do make them wait another quarter, I suppose it's possible that it would be cutting it close to even get in before the end of the year, which would be bad news for my December 1080s potentially. But I still don't think so. I think that the front running is going to continue because the investors have already made their choice. Like it's for them to never get in would be kind of weird. And it only benefits the S&P 500 for them to be in. So I'm not even sure what the benefit to keeping them out for an extra quarter would be, other than like an ego or like a power move or something, maybe. But eventually it seems like they would just have to relent. So not a financial advice, but a lot of times there's front running and then actually a sell-off. And it's one of those buy the rumor, sell the news kind of things, right? There's a lot of front running, then there's the index inclusion. And then even though there's a ton of inflows, there's a bunch of people who were really just not expecting to do anything more than take some short-term profits. And they will dump. They will dump their shares. Eventually, the pendulum swings back and all of those passive inflows reward strategy more than they hurt strategy. But I'm sure there will be some unhappy campers that will turn around and say, you know, at some point, if we get a ton of front running and we get some big face melting rallies, and you know, if there is some kind of sell off after inclusion, people will be like, "Oh, I thought, you know, I thought you said that this was good for, this was good to be included. Like, why number go down?" And so some of those things can happen, but the longer they delay it, it just seems like that will just feed the frenzy, and the front run, it'll just give it even more and more time to front run. So I will probably be one of those people trimming my position, but it won't be trimming the actual numbers of shares. I will be trimming my leverage at that point. Like if strategy gets included in the S&P 500 and the price is whatever, double what it is now. Or if it, you know, if we get some kind of leg up to 1,000 and then potentially it has a 50% correction like it's done the last 2 times, right? We had a pump to, this is post split, it was 178. Well, this isn't exactly very accurate. I think it was like 200 a share. Pre-split, it was like 2,000. It might actually been, I think Jeff said it was like 1999.90 or something. And then, you know, it bottomed out at not quite a 50% correction, but damn near close to it. Once, twice, 3 times, right? I guess we had a triple bottom, 115 to 125-ish. And then we got our next leg up. We hit more like 500 a share, I believe, after hours, and then we had a correction to 250. So if we get the next leg up to 1,000, I mean, a correction to back to 500 is not like unheard of. So anyway, the point is, once we get this leg up, I will probably have more shares than I do now, but I will have dumped all of these long calls, right? There won't be no more, there won't be any more of this 1080 shenanigans, or even these somewhat, I guess these would probably be grain specials here. These are about 20% out of the money. Those will all be gone. My Januaries will be gone. And when I say they'll be gone, I will probably try not to screw up like I did last time. So I've had these open for 42 days, and I've got 172 days left. I will not just close them out like I did with some positions recently. I will just hedge them. So I'll go out and I'll sell the 520 or the 540 strike and like hedge 99% of this position out, so that when it's 366 days old on whatever, I'll probably give it a few extra days just to make sure there's no dumb shit with leap year or whatever. But you know, sometime after like December 20th, 25th, maybe just before the end of the year, but December 30th. Sorry, actually, no, I'm screwing that. That's right. That's for the Januaries. I'll probably, actually, now that I think about it, I got to do some math. I've had them open for 242 plus 172 is 314, 414. Okay, so actually, I should be good to close these anytime in December. I was losing my mind a little bit. I can't close these after they expire. That's kind of dumb. So same calculations I got to do here. I've had this open for 221 days. We've got 200 left. That's 440 days. Okay, so I've actually got a bunch of, I've got like 100 days. I can start closing these 890s actually like 3 months before. So maybe even like November. I gotta do the math and get the exact days right. But this one, yeah, this is like 410 days. So that's about 50 days. So I might have to cut this one a little bit closer and like wait till at least November. I don't like holding these for less than 90 days, but that's the point, is really all of that is kind of meaningless. If we went to 1,000 tomorrow, I could just hedge this position out. That's kind of the point. And then I can finally close this position and the hedge when the days open is greater than 365. So really, I don't have to do any of that dumbass math I was just talking about. All I got to do is watch this column right here and wait for this to say 366, and I should get long-term capital gains tax at that point, which would still be within the 2025 tax year. So I do have that little bit of flexibility with the Januaries. If I do have to pay taxes on these, which is kind of a stretch because right now they're down 90%. But if I ended up actually turning this into a profitable position and I wanted to push those taxes another year, I could wait until January 1st, technically, on this position. If it's still a loser, I could take the loss on December 31st to make sure that I don't pay as much taxes in 2025. So that took me a little bit of time to get my brain around the timing, but I think I got it figured out now. So yeah, I'm if we do hit, all-time highs or whatever and get a nice leg up to 1,000 or something, I won't be selling any of these shares. And really, I would be converting as many of these long calls either into more strategy shares, even at all-time highs, or more likely Tesla. I exited all of my Tesla positions, and that was kind of the reminder that I screwed up. I should have just hedged out my Tesla positions instead of selling them and taking short-term capital gains taxes. But what are you going to do? Where's the chart? So hopefully, like, Tesla won't have ramped up their robo-taxis yet. They really won't have had like insane earnings calls where Tesla's price just gaps up. Now the only thing is they actually own quite a nice chunk of Bitcoin themselves. And so if Bitcoin makes a run, I mean, Tesla's price could run at some point too, just because even if the cybercabs are not printing money, maybe their Bitcoin stash will be. So no guarantee that Tesla will behave as I want it to and stay cheap for me, waiting for Strategy's next rally. But that's kind of the master plan if the market gods want to participate and cooperate with me. That's kind of my plan, is to dump all the long calls after the next rally for hopefully a profit, and then convert them either into Tesla, be somewhat diversified, or maybe even some more shares of Strategy. And then I'm not convinced that the Bitcoin bull market will be over necessarily at that point. But my portfolio will have reached a point where I don't need it to double again, and my future will basically be pretty much secured at that point. So I would probably be very aggressive, when Strategy gets to close to 1,000 a share. I'll be very aggressive with the covered call selling. And at that point, if I cap my upside, it's like, doesn't really matter. At that point, it's like, it's just choosing how much winning to have, a little bit of winning or a lot of winning. There's once strategy gets to that level, it's kind of like all winning all the time. Even if there was a correction back to 500, like correcting back to what my portfolio looks like now, and it wouldn't even correct that low because all of the leverage would be gone. So plus I'd be collecting covered call premium pretty aggressively, so my account wouldn't drop to 50% even if strategy did. So at that point, it'll be kind of meaningless whether the bull cycle turns into a bear market. But anyway, 30 minutes left. I don't think I'm going to have much to trade. I might have have something expiring in the 5K account challenge. But all of the covered calls I sold, of course, are getting wrecked, which is to be expected. And even with that being said, I still haven't chipped away at this little bit of margin use that I have. But them's the breaks. So earnings is August 7th. I will hold these for another month and 5 weeks, I guess. And then we'll see how much it's going to cost me to cover these on August 7th. I won't hold any more covered calls than I really pretty much have to over earnings, just in case. Like, it seems like the front running has already started, but just in case there's a gap up, like, I'm not making any predictions whether it goes up or down, but just for those 4 days a year for earnings calls, I will I try to take as many covered calls off as I can stomach. Yeah, so nothing to do but sit here and watch these, really. And if I do end up getting like wrecked really bad on these covered calls, like if the price runs to 450, 500 or something before August 7th, I'd probably just have to peel this off and just sell this poor man's covered call to pay for it, which would be totally fine. I'll do a little bit more of a deeper dive on the covered call ETF challenge. I was talking about it in another thread, and somebody was like kind of not really believing me that I'm finally beating the covered call ETFs. I guess Jay is like, for MSTY, is a renowned trader. I've watched a couple of his interviews, and I think he's very knowledgeable, but beating them or even losing to them doesn't necessarily. I'm gonna have to do like a super deep dive on actual like premiums collected just to see who generated the most premiums. But I could beat them, and it might not necessarily have anything to do with who collected the most premiums or who traded the best, because fortunately or unfortunately, depending on how you want to look at it, these ETFs also profit or lose based on market sentiment, right? So they could do all perfect trades, but if market sentiment, is against them and everybody pulls all their money out, then the price of their stock goes down. So they could trade perfectly and their stock could still trade down, and I could win the challenge. But the same is also true on the other side. Like, I could trade perfectly, they could trade like shit, but if market sentiment pumps the covered call ETFs higher than it pumps strategy itself, then they could win the challenge, even though they trade, their trades were not necessarily all of that great. But yeah, at this point, I think they're up 5%. IMST will probably pay that dividend out today. Probably today. And then I should probably wake up tomorrow with an extra, I don't know, $4,000 worth of shares at current prices. Is that 80 shares? Yeah, something like that. So I'll end up with some more IMST shares tomorrow, and they will catch up a little bit. But yeah, they're up about 5%, and I think I'm up about 11. And I made some pretty big mistakes early on, just plowing premium into the 1080s in June and July, which all expired 90% worthless. So I won't be making those kind of mistakes again. I just don't anticipate, unless the market sentiment just pumps their prices up, their share prices up fantastically. I don't really see how they're going to be able to come back and kind of turn the tables back on me again. So we'll see. Anything could happen. And to be fair, I watched an interview with Jay the other day, and he said something about these long synthetic positions actually have carry cost for them. I assume it has something to do with margin. And so that's a little bit of headwind that they have to deal with too, right? So if they have to pay whatever the margin rate is, and I'm sure they get very favorable margin rates, so they probably only have to pay a few percentage points or whatever. But as a retail investor, we don't have to carry. We don't have a carry cost to just own straight shares, right? We don't have any regulations telling us that we can't own shares and that we have to construct all these elaborate synthetic positions. So that was news to me. So I actually have to give them a little bit of credit that they're able to pump out this much premium with those kind of headwinds. But as a retail investor, why would I want to give them my money so that they can run the strategy not by choice, not inefficiently by choice, but just because they have all these regulations? They have to factor that carry cost into their trades and make sure that they're not only delivering premium, but that they're overcoming all of these fees and things that they have to deal with. And that may explain why some of their positions look a little crazy to me. I'm like, well, why are you taking this position? And why are you picking this strike? And why are you picking this many days to expiration? And they just may have a laundry list of other ETF related rigmarole that they have to deal with that causes them to trade a certain way. But that kind of brings me back to, as a retail trader, I don't have any of those issues. The main reason why I can see doing this is just literally paying them for the convenience, right? I go to a restaurant not to get necessarily a higher quality meal, because I might be able to cook just as well as anybody else, but to have someone cook it for me, bring it to the table, and clean up the mess, and I just get to walk away, yeah, I'm willing to pay 10x for that convenience. So I don't begrudge anybody, for taking advantage of these. If they put themselves on a budget and they're like, okay, if I invest this much of my portfolio here, and then however much they pay me as premiums, that's my spending money. And now I'm on a budget. I have to live within that means. And then, maybe I've got my Bitcoin stack and I got my strategy stack and whatever. You can diversify into any of the other Bitcoin treasuries or whatnot. But if people just want to kind of be a little lazy and figure, all right, 10% on a month, or I think the IMST dividend was pretty bad. It's like $1.87 per share, which worked out to like 3.5% or something. But 3.5% a month is pretty good compared to other dividends. So I think we're a little bit spoiled in the Bitcoin treasury company strategy, MicroStrategy space, because we just expect returns on top of returns on top of returns. But yeah, the dividend on IMST was a little disappointing, but I think it's to be expected, and they were a little bit longer than they were short, so it kind of makes sense that the dividends would be bad since strategy really didn't do much with their price. But if we get the next leg up and IMST had a bunch of long positions and they're able to return some of those profits to the investors, then maybe they will have a really impressive dividend during a rally or something. I don't know. The jury's still out on all of that. We're going to basically experiencing it in real time. We've got much more longer history on MSTY to see what kind of dividends they returned during the mania of November. But yeah, on the whole, I still think it's better to like if I wanted to live off of my portfolio, I think I would rather just own strategy and then sell however many shares I needed to live off of that month. I still think that probably outperforms these covered call ETFs. But taxes could be I don't know if there's a tax advantage to these as well. I think all of the return of capital isn't taxed or something. Is that true? And somebody can let me know. Not a tax advisor. I'm not a financial advisor or a tax advisor. So, what's up, Howard? Wonder if we're better off waiting. It might make the bull last longer. Oh, I see what you mean. So just let it boil. And yeah, if they do that, strategy would enter the S&P 500 at some astronomically high ranking. It would be pretty wild. Matthias, reasons the CMTE could reject. Strategy doesn't represent a sector of the real economy. And they're a treasury, not an operational success. They don't derive EPS from products, services, and sales. Yeah, they could come up with something. But this swell of backlash that they might face could cause them to rethink that. Like, I assume that they would face some significant pressures if they tried to keep them out. But you never know. You never know what kind of forces are behind the scenes unless you're actually behind the scenes with them. Dude face, yeah, I don't want to be a wet blanket, but I could see them not including strategy this soon based on the reasons mentioned. They made Tesla wait and plenty of others. Yeah, exactly. And there's no reason why they would treat strategy better than they treated Tesla or anybody else. Love the new logo. Yeah, appreciate it. Yeah, we got like a little overlay with the little True North stuff and investment grade podcast. I'm not sure if Gangster Rap intros is investment grade, but what are you gonna do? What's up, Dylan? What are the pros and cons of hedging your positions versus closing them out? So the only benefit really would be taxable. So again, double check. But if I take profits on this, well, there aren't any profits to be had here. But let's just say these 530s were in profit, and I wanted to take those profits and lock them in. I can just right click and close the positions. Boom, I'd get the money, right? But since I've only had them open for 242 days, I would be taxed at short-term capital gains taxes. And what I believe is that if I can hold these until they're 366 days open, that I would have held them for a year and that I would qualify for long-term capital gains taxes. However, if the price went to 1,000 tomorrow and then I sit here and do nothing, the price could go back to $450 a share by the time I was able to capitalize on the long term, and I might have just pissed away all my profits. So the way around that would be, instead of closing 20 positions and collecting my $68,000 today, I can go out here to the same options chain, and instead of selling these calls here, I would sell 20 strikes next to it. The delta on the ones that I hold are the 35. The deltas that I would be selling are 37. So I would be hedging out 98% of my profits, and I could just pick up 70 grand if I sell the 520s, or 64 grand if I sell the 540s. And that in effect takes profits in this position but allows me to hold it until it qualifies for long-term capital gains. And then if the price is at 1,000, and then by the time expiration comes in, or by the time I can actually fully exit this position, if strategy goes up to 1,000 and back to 500 and I lose all the money in this position, I will gain all of that money in this position. So they basically just cancel each other out. And then when I'm ready to take profits and long-term capital gains on this position, then I would just highlight them both, close them both at the same time, and get my long-term capital gains in this position, and then just take whatever kind of hit against this position. As I understand it, qualified dividends taxed at 0% if you have no other income on the first 48K earned in a year, then at 15%. Are these covered call ETFs qualified dividends though, or is that in like regular dividends? Let's see. Additionally, you can do an equity-based loan on your underlying. Tasty doesn't offer this product. Others do. So borrowing against shares and watching your margin ability levels you could borrow at. Yeah, I asked Tasty about it. I was like, well, how do I borrow against my portfolio? When they're like, just take the money out and use margin. I was like, oh, okay, that kind of, I don't really like that answer, but whatever. Close to prime rate and not pay income on the borrow. That's an alternative selling instead of capitalizing a gain. And that you're talking on that one, you're talking about shares, right? Because with the calls, I mean, you have to exit that position at some point. All right, my discretionary spending. Again, I've got 46 days to expiration on these. I sold these out a little bit longer than I prefer to, because the August 8th wasn't available. They hadn't opened up that day on the options chain yet. Damn, these 350s are still not profitable, which is fine. I'm probably collected enough on the covered calls over the last 6 months to compensate for it. But it'd be nice to see this go positive at some point. Yeah, nothing really to do there. And here's the challenge account. This account started out with I think it's $15,990. I think it's like $241 today. So up about 11%. And yeah, I don't have quite as many of the 1080s as I would like. But these two poor men's covered calls should help cover my shares position. If we get a quick leg up to 500 and these strikes get blown out, I'll either take profits in these 1080s and or the poor men's covered calls to pay for those rolls. So doing things like this is what retail investors have available to us. We have that extra flexibility to take on a little bit more risk with some long calls. I'm stashing these attack the tail positions that, as I mentioned, did not work out very well in June and July. So hopefully they will work out much better over the next 90 days. So we'll see. Yeah, anyway, nothing to do but sit here and wait. In this account, I will probably have to hold a few covered call positions over earnings because this is just a rule I'm holding myself to, since this is should be a premium generating. Like if I was an ETF, this would be a premium generating position. I'm not just going to take days off because it's earnings, right? So I'll probably try to get this as close to zero as possible, but still positive. So I don't know how many of these I'll be able to. Let's see, what is my net theta on 5 positions? Yeah, I can only close 3 of these covered calls, maybe at the most. 3, maybe 4. We'll see. All right, that's all of those accounts. Let me hit the 5K account. I think I probably had something expire, so I should have some cash to spend, I think. Had something expire on Friday. So I've got $26.50 in options collateral. I've got $4,000 in cash. So that means about $13.50 is available buying power. Okay, so I already have a 10.5 put for Friday. That's interesting. So let me add a CLSK, potentially. This is a short week, so I said Friday, but it's actually really Thursday. So I'll sell the 11, collect 26 bucks. That's about 2.5% return on capital in a week, even a short week. So that's pretty legit. Cha-ching. I don't even remember when I put on this 10.5 put. When the hell did I do this? Date sold 6/27. Oh, okay, so I sold it on Friday. Yeah, that makes sense. Okay, duh. And then the ones that are for July 18th, those are the ones that me and my brother copy trade. So my brother-in-law. So we'll have to roll these. GME, what's GME doing? Okay, so I've got this. Okay, GME's up a little bit. I think my cost base is like 28 a share on GME, so I really need it. I'll be more than happy if that just went to 30 and I could just dump that position and be done with it. It was fun for a minute, I suppose. But again, the 425 call, I'll just sit and hold on to that until August 7th when we have earnings. This is the 250 against it. That actually might be a perfect opportunity for me to, let's see, August 7th. Actually, I might have to deal with this in July. This 1017 call will be 90 days to expiration in the middle of July, so I'll probably have to reconfigure my position and roll it out another 3 months to January. It'll make this a little bit more expensive. So we'll see how much I can even afford. I may have to juggle some positions. Might have to sell the 1080s or get rid of my mining positions to make that happen. We'll see. And the 1080s, there's probably a little bit of profit in here. Yeah, that's not bad. These are up 20%. These are my only 1080s that are in profit. But I think I smartly purchased these when strategy was down. Yeah, that's all I got. We'll check the chats and call it a day. Howard says, my strike dividends were labeled non-qualified in Schwab. No shit. That's crazy. I was thinking about strike. We were kind of discussing in the True North chat. We're talking about strike a little bit. And it occurred to me that strike, if you have strike set up as a drip and you're reinvesting the dividends into more shares of strike, like strike is a perpetual call option on the price of strategy. So strike is a call option, and if you set up a drip, it's a call option that buys more call options of itself in perpetuity. Although that was kind of wild. Dude face Solana is pumping a little bit because the first ETF got approved. Shipcoin sale on. Really? STRK bananas. BANANAS. All right, cool. We are all caught up on the chats. Didn't really do any trading. We talked about trading, but that'll have to be